Next on the list here, we have VUG, which is the Vanguard Growth ETF. This fund is going to provide you with exposure to large US growth stocks by tracking the CRSP US Large Cap Growth Index. Now, this index tracks the performance of 183 leading US companies with above average revenue growth. Now, something like VUG is going to be more aggressive than VTI or VOO, for example, because you are concentrated in growth stocks. That means during a bull market, when stocks are going up overall, you would typically expect something like this to outperform. However, during a bear market, when we're seeing a crash or correction take place, this is going to get hit harder than something like VOO or VTI, for example. As far as the expense ratio goes, this comes in at 0.04%, which is still extremely low, but slightly more than some of the others that we've covered already. And the dividend yield in this case is just 0.45%. It's going to be significantly lower because this fund is placing an emphasis on growth stocks, and a lot of these companies are reinvesting their profits versus paying out dividends, hence the lower overall yield. Just to show you an example of the outperformance here, the year-to-date return from this is 23.74%. We saw with VTI, for example, it was around 20%. So because this is concentrated in growth, it is going to outperform in a bull market. Taking a look here at the style box, this is in the top right quadrant because it is focused on growth and it is also focused on large-sized companies. As mentioned, there's about 183 companies included, and this is going to be the largest companies with above average revenue growth. So it is going to have a higher overall valuation in terms of what people are paying for exposure to earnings, but that's because those earnings are expected to grow a lot in the future. At least hopefully they do, so long as we continue in a strong overall economy. And you can actually see that over here looking at the PE ratio. So for this fund, it's trading at a 37.3x overall, and the price to book ratio is coming in at an 11x. So this is trading at a higher valuation compared to a value fund. That's again because of the future earnings potential expected from these companies. This is going to show us the overall sector exposure, and this is heavily concentrated into technology. 59.4% of the entire fund is in tech. The next largest component here is consumer discretionary at 16.6%, and that is going to be followed by industrials at 8.4%, healthcare at 7.4%, and so forth. The main thing you want to be aware of here is just how much of your money is going into tech, and that is because that is going to be most of the large growing companies in today's economy because of how tech focused everything has become. Again, if we scroll down, we can get holdings details, and you can see how concentrated this portfolio is. 13% of the entire fund goes right into Apple, followed by Microsoft at about 12%, and Nvidia here at just shy of 11%. So you're looking at about 36% of the entire fund. More than a third of all of the money invested just goes right into those top 3 big tech names, but you will notice some different company names listed here in the top 10. For example, Visa as well as Tesla, and that's because these are deemed growth stocks. And some of the other components of VOO or VTI, for example, although they are extremely large companies, they may not be considered to be growth stocks, so those are excluded from this fund.